Welcome to our deep dive on one of the most consequential retirement choices. Whether to take a defined benefit pension as a guaranteed lifetime annuity or as a one-time lump sum rollover. To set the stage, we will compare predictability versus growth potential, and we will walk step by step through objective ways to value each option. Stay with me as we build from fundamentals to practical decision tools, and by the end, you will have a framework you can apply to your own situation. First, we will frame the dilemma and define the annuity and lump sum options. Next, we will walk through present value analysis to compare them apples to apples. Then, we will introduce the SPIA benchmark test from real-world pricing. Afterward, we will examine health and longevity factors, followed by the investment responsibilities you assume with a lump sum. Finally, we will reinforce learning with quizzes, wrap with an action checklist and key takeaways, and close with a brief disclaimer. Moving into the core dilemma, consider the choice as predictable survival versus market appreciation. The lifetime annuity offers guaranteed income and protection against outliving your money. On the other hand, the lump sum offers control, potential for growth, and flexibility for legacy, but it transfers investment and sequence of returns risk to you. Your decision affects cash flow stability, inflation resilience, survivor protections, and the way your assets transfer to heirs. Now let us quickly map the landscape. The annuity provides guaranteed payments for life, which is effectively insurance against longevity risk. It reduces the behavioral risk of poorly timed decisions and simplifies management. However, it can be less flexible and is exposed to the credit strength of the pension plan or insurer. In contrast, the lump sum grants control over allocation, withdrawals, and legacy planning. Yet, it introduces market volatility, sequence of returns risk, and requires ongoing attention and discipline. The key variables that tip the balance include the discount rate you use to compare options, your health and expected longevity, inflation assumptions, any survivor benefits, and the fees and taxes involved. To truly compare the monthly annuity to the lump sum, you need a present value analysis. Begin by gathering the monthly benefit, the start date of payments, the survivor percentage, any cost of living adjustments, and details on plan health. Next, select a discount rate carefully. Some use a high-quality bond yield to reflect low risk. Others use a required return aligned with portfolio expectations. Then, model the cash flows explicitly, including survivor reductions and any COLA. In a spreadsheet, use the PV function to discount the payment stream back to today. It is essential to run sensitivity tests with multiple discount rates to observe how the conclusion changes. Validate with a financial calculator or software built to compare pension payouts. Finally, stress test edge cases like very long lifespans, different inflation profiles, and planned solvency scenarios. Record your assumptions so you or an advisor can revisit and refine them later. Let us walk through the decision flow. We start by verifying the financial strength of the pension plan or insurer. Next, we assess personal health and likely longevity. Then we ask whether you need a strong guaranteed income floor to cover essential expenses. After that, we compute present value at different discount rates to see how sensitive the result is. We then bring in the SPIA benchmark by comparing the market price of an immediate annuity offering equivalent benefits to the plan's annuity. The next branch evaluates your desire, skill, and time to manage investments, plus your behavioral temperament. We also consider inflation protection options through COLA, portfolio tilts, or tips. The flow culminates in one of several outcomes. Leaning toward annuity if the SPIA market price exceeds your lump sum for the same benefits, or if you need a strong income floor and have limited investing capacity. Leaning toward a lump sum if PV and SPIA comparisons favor cash and you have the discipline to manage risk, or choosing partial annuitization or laddering as a middle ground. Now let us introduce a powerful reality check, the SPIA benchmark. Obtain real quotes for an immediate annuity that mirrors your plan's payout structure, start age, and survivor provisions. If the market price for that SPIA is higher than your plan's lump sum, it indicates that the guaranteed income embedded in your pension is relatively generous, which argues for taking the annuity. Conversely, if your plan's lump sum exceeds the SPIA market cost for identical benefits, it suggests taking the cash may be advantageous. While interpreting, remember to compare insurer financial strength, understand your state's guarantee association limits, and account for any differences in cost of living adjustments and fees. Comparing side by side clarifies the stakes. The annuity's strengths are lifetime income, simplicity, and a built-in hedge against living longer than expected, which also reduces behavioral errors. Its weaknesses include reduced flexibility, potential limitations on legacy, exposure to the credit quality of the plan or insurer, and possible erosion from inflation if there is no cost of living adjustment. The lump sum offers control, higher potential returns, legacy customization, and options to hedge inflation through asset selection. But you absorb market volatility and sequence of returns risk, must avoid behavioral mistakes, and accept the responsibility to manage the portfolio for the long haul without a built-in longevity guarantee. Here is a quick assignment of risks. With an annuity, longevity and market risk are transferred to the plan or insurer, while you retain inflation risk unless you have a cost of living adjustment. Behavioral risk tends to be lower because there are fewer decisions. You do take on credit risk to the issuer. Legacy control is generally lower. With a lump sum, you absorb market and sequence risk, as well as behavioral risk, but you gain legacy control and can hedge inflation through asset allocation. Credit risk is typically reduced if you diversify across investment products and custodians. Health is an essential variable that changes the calculus. If your expected lifespan is shorter due to health concerns, the lump sum can be advantageous because the remaining assets can pass to heirs rather than the annuity payments ending at death. Conversely, if you are in excellent health and want protection against living a very long time, the annuity provides a strong hedge against longevity risk. Additionally, evaluate survivor benefits carefully. Options like 50, 75, or 100% continuation affect payouts and should be compared to how a lump sum could support a surviving spouse or partner. If you choose the lump sum, your success hinges on disciplined investment management. Establish an investment policy statement to govern allocation, rebalancing, and withdrawal rules. Implement risk controls to reduce sequence of returns risk, which is particularly dangerous early in retirement. Address inflation by incorporating assets such as tips, equities, or select real assets aligned with your risk tolerance. Finally, leave room to adapt. If markets or behavior threaten the sustainability of your plan, you can consider partial annuitization in later years to restore a secure income floor. Quiz time. The question is, if you lower the discount rate in your present value analysis, which option tends to look more valuable? Your options are A, the lump sum, B, the annuity payments, C, they are unaffected, or D, the survivor benefit only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, the annuity payments. Reducing the discount rate increases the present value of future cash flows, which benefits the annuity stream relative to the fixed lump sum. Here is the second question. What does it suggest if the market price of an equivalent immediate annuity is higher than your plan's lump sum? Options are A, the annuity is likely a better deal, B, the lump sum is unquestionably superior, C, you should always split 50-50, or D, discount rate choice is irrelevant. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. If the SPIA market price is higher than your plan's lump sum for the same benefits, that indicates the guarantees are relatively valuable, which supports taking the annuity. Before we conclude, a reminder. This content is educational. It is not individualized financial, tax, or legal advice. Your circumstances are unique, and you should consult a qualified professional who can provide recommendations based on your personal goals, risk tolerance, health considerations, tax situation, and the specific terms of your pension plan. To recap the essentials, perform a present value comparison across a range of discount rates, ground your analysis with SPIA market pricing, incorporate health and survivor objectives, evaluate your capability and temperament for managing investments, and keep hybrid approaches like partial annuitization or laddering on the table. In summary, the annuity emphasizes safety, longevity protection, and simplicity, while the lump sum delivers control and potential growth in exchange for responsibility and risk. Let objective data inform the decision by running present value analyses, benchmarking with SPIA prices, and stress testing assumptions. Above all, align the choice with your health profile, cash flow needs, goals, and your realistic behavioral tendencies. Thank you for watching. If you found this useful, please like, share, and subscribe Tell us in the comments which way you are leaning and why. Your insights can help others facing the same decision.